Welcome to the Tax Talk podcast. On today's episode, I have Kit Richmond. Kit is here to discuss everything IPPs, individual pension plans. So if you are a small business owner with a significant salary at the particular age of 40 plus, and you are looking for some options for your pension within that small business, this is the episode that you are going to want to watch. Kit is going to unpack this topic in detail with me, and we will provide you with the details you need to make the decision to help you build that pension. Welcome to the Tax Talk podcast. On this episode, I am talking with Kit Richmond. Kit is a wealth advisor and portfolio manager at the MacDougall Wealth Management Group with National Bank Financial. Their team partners with entrepreneurs, professionals, business owners, and family farms in their goal to continue wealth creation, enable protection, and structure transition. The MacDougall team offers a unique approach to wealth management with expertise and personal service to guide you and your family. Kit, I just want to thank you for taking some time out of your busy schedule to hop on the podcast with me today.
Thanks a lot, Jared. Really appreciate it.
Excellent. So we are diving into a topic that seems to be coming up with my clients on a more regular basis, and that is individual pension plans. I figured Kit would be a good resource on this, and I'm looking forward to the insight that he can provide to you today. So let us just start with the most basic of questions. What is an individual pension plan or an IPP?
So IPP, individual pension plans, are basically a defined benefit plan that is generally sponsored by a corporation.
Okay.
And there's some advantages under the Income Tax Act in doing that. Okay. So it's similar to an RRSP in certain senses.
Okay.
But it has some advantages in specific situations.
Okay.
That might apply to some of the listeners to this podcast.
Okay.
So
fair enough. So in regards to that, is it something that someone, if they've got a small business corp, they could go set themselves up an IPP themselves? Do they need to speak to you? Is there another advisor that needs to be involved with this? How does that kind of come about?
So good question. So generally, an IPP is set up with three different collaborating professionals and the business owner or the professional service provider that is the client. Okay. So the first one is an accountant.
Okay. Fair.
Okay. So that makes a lot of sense for most things, right?
As it
and
would.
The second one is an actuarial team.
Okay.
So because it is a pension plan that is regulated under the CRA, it does need to file certain disclosures every year. And then also every 3 years is something called a triannual review. So there's a bit of a review there that they need to file with CRA. Okay. And then the third is a wealth advisor or wealth advisor team. Because you're going to need to invest the funds within the pension plan.
Makes sense. So kind of similar to other investment opportunities that people might be looking into, it's important to get the right people on your team to ensure that you're getting the proper plan put into place that's going to benefit you. So getting these individuals on your team to get this pension plan potentially in place is going to be of utmost importance for you if it's an option for you in the business.
Right. And I think the first step is to ask your accountant or your wealth advisor or one that you know that does offer this service to say, is this right for me? Right. Before, because there are some costs involved, but the advantages are greatly increased versus the cost. So if it fits for you and your family. So that's really important to ask your accountant or ask your wealth advisor. And generally they have contacts in the actuarial world to make that happen for you.
Yeah. And I mean, generally speaking, whenever I have clients come into my office, and I'm guessing it's probably the same for you, they'll be asking if a particular plan or thought makes sense for them. And usually the general discussion right off the hop is, well, it depends. We kind of need to get into some of the details to determine if it is beneficial to you. Maybe the IPP is the perfect thing for you. Maybe it's the worst thing you could possibly do in the world. So having that discussion before you just jump into something, just like anything in business, probably makes the most sense to ensure you're getting the best bang for your buck down the road. So
Yeah, and that depends on, family dynamics, whether you're an incorporated business or not.
Okay.
There's a couple of different things. Age is actually a big one for IPPs because the advantages accrue later on as you get a bit older.
Okay.
The other thing too is, and maybe you'll talk about who the ideal candidate is, because that's probably what we're going to next, right?
For sure. Yeah, so now that we've understood what the IPP is, who can open it, what is that ideal candidate? Is there a certain business owner that we're looking to gear this towards? I know some clients have brought this up as a potential investment/retirement vehicle for themselves. Maybe they don't want to go with the traditional hold of investments in the corporation. Are there other options, one of which being this IPP? So is there someone specific that's maybe listening to this podcast that could maybe say, yeah, this is me, I should go talk to my accountant, I should go talk to Kit and put this into place?
So the first thing that we look for is actually age.
Okay.
Because it actually doesn't make any sense from a math basis to do an IPP versus RRSPs or maybe holdco investing or whatever until you're 40.
Okay.
Okay. So that's the first thing. The other question that actually is really important is, do they have excess capacity to contribute to savings, right? Because if they're not even able to make the normal registered savings or the normal contributions to a holdco, it doesn't make any sense to do an IPP. You really have to be committed to making that excess savings.
Okay.
Right.
Okay.
So having a corporation is one thing, because the corporation actually needs to sponsor the IPP.
Oh, okay. Okay.
And in Alberta, the contributions to the IPP are not a requirement. They're a right by the corporation.
Okay.
So that would mean that every year you don't have to contribute, but you have the option to contribute, right? So we want to make sure that they have enough cash to actually do it,
right,
but also that they can, do that over time, and you can accrue excess if you need to.
Right. Okay. So you obviously need to get to a point in life where you're probably somewhat established, obviously to that age bracket that you're in, where the math makes sense, and then be able to probably commit to this on the longer term, I would guess. I mean,
yes.
You don't want to just set up the IPP and put a little bit in here
Yes.
and put a little bit there. You want to be committed to this. So I would guess it would probably be more so of a longer term thought, maybe some sort of generational planning that would come into that as well.
That can come into it. I think that's a bit later, generally.
Okay.
But the question does need to be asked: are your business relationships and your incorporation, everything else, is this the setup that you're going to want for a long time?
Right.
Right. So, say you're a medical professional and you have that PC set up, that professional corporation, and you're going to act in that way for 10, 20, 25 years. That's already set up. Then that makes sense to sponsor the IPP through that. Right?
Okay. So kind of similarly, if someone were to come in and was considering maybe a permanent life insurance policy, there's obviously maybe a more permanent piece to this discussion that needs to take place. You want to be planning not just for the next 5-10 years, but beyond that, and get a good scope of where the business is now, where it's going, what the general thought is with a lot of probably different variables. And that's probably why it makes sense to get that team in place to ensure that you can kind of play out some of the different scenarios that might crop up.
So, yeah, the conversation has to be around, is this the setup that you're intending on having for the foreseeable future in your work?
Right.
Whether that's the business or professional corporation or whatever, right?
Okay.
The other thing that's really beneficial is that you can name beneficiaries that are not involved directly in the corporation, right? So spouses are obviously one that happens quite a bit.
Right.
And then longer term planning, we can talk about that. There's actually other people that you can name as beneficiaries, which is an advantage.
For sure. No, that's good. So we've discussed maybe the individual that this would be appropriate to. Is that individual needing a certain annual salary to make the mathematics of this work? You touched on, before, at least having the savings to put into some of those registered plans, i.e. the RRSPs. So is there a certain annual salary that this individual should be expecting to see over the course of X amount of time to maybe make this IPP work, mathematically speaking?
So there's the salary component, but then there's also the excess cash that's building up in the corporation, right? So there's two elements to that.
Okay.
It is important that the IPP is determined on T4 income.
Okay.
Right? Just like your normal pension contributions, like your RRSP room.
For sure.
Okay.
Yeah.
So your RRSP room maxes out in the low 30,000s right now, which is 18% of T4 income, right?
sure.
So what that is, the IPP crosses over at 40 and it increases there. So it can be up to 30% of your income.
Okay.
You know, in the six figures, we're getting higher and higher, right? In the six figures, right? So that's really where it makes a really big difference.
Okay.
Because you can put in $10,000-$20,000 more per year, right? Okay. And it's also corporate dollars, and you can maybe explain that a bit more, which is different.
Right. No, that's good. So, yeah, if you're getting to that point where you're well established, you're drawing that consistent salary, you're maybe maxing out those RSPs, and based on your discussion with your accountant, your wealth advisor, this is the strategy that makes the most sense for you. Maybe that IPP then is the next step to be able to unlock some additional dollars that you can put away for the future, for retirement, and as we probably get into some of these more generational pieces. So it's good to know that there's that option for some of these maybe higher income earners to go down that path.
Yeah, you can accelerate your savings.
Okay.
Right, and you can use corporate dollars to do it, right, which is beneficial.
For sure.
But there is another element too in that there's creditor protection and a couple other things, right? So there's benefits, there's some costs associated with it.
Sure.
What I would say is, if you are interested in it, you need to do a review of all your T4 income for the last 5 or 10 years.
Okay.
You can qualify some of the RRSPs to go into the IPP, to roll in. Okay. So that gives you some advantages there too, right? So when you're talking to clients, what you want to do is you say, well, let's go back for the last 5 or 10 years. What is your T4 income, right? So if business owners are paying themselves through dividends only, this strategy doesn't work. Right. So you have to have that history there, right? So that's why we can talk about that earlier on in their 30s and maybe early 40s, right? So that just gives you optionality.
Okay. So if you maybe had gotten into the mid 40s, tailing into the late 50s, and you had historically taken dividends, is that IPP ship kind of sailed for you then? Or is there still time to maybe make the switch from dividends to wages at that point in time?
There's still time.
Yeah,
for sure. It depends on how long you're going to live, which is hard to determine.
Fair enough.
And then your spousal situation and all that sort of stuff. But there's still time, especially if you're accruing a lot of cash within the company, right? And you're paying for lifestyle expenses. So if you're paying for lifestyle expenses with T4 anyways, you might as well use that to your benefit, right?
I guess that makes sense. Yeah. If you've taken out that income, you might as well take it in maybe a slightly different manner.
You have personal income anyways, right?
Yeah,
and personal expenses, right, that you need to take care of.
Yeah, it's coming out one way or the other. So maybe you make a pivot and you start utilizing this potential option down the road. So I think it's good that you kind of have that knowledge that maybe you are down the road, but you can make a pivot. And I generally kind of indicate that to clients. I mean, your situation always is open for interpretation and the plans always change. I mean, what might work for you this year or for these 5 years may not work down the road. So I always try and preach, if you need to make a change, then let's talk about it. And maybe there's some new options and things always change on the tax side. And I'm sure they do with the investment world too, that you never put a plan in place in one day and then you just leave it for the next 15, 20 years. That's not the way planning works. You got to sit down, you have a discussion, and then you continually look at that plan and say, well, does it still meet my needs and my goals as I outlined them 3 years ago? Or am I way offside on this now and we got to revise this? So
yeah, situations change. And with the IPP too, you have some options getting out. Okay. So you can purchase an annuity if you want, right? If you're the right age for that, if you want to do something like that. You can push it back into an RSP and a LIRA, which is a locked-in retirement account. If people don't know what the acronym is for that. And you can do unlocking and a whole bunch of other things, right? So it's not like you're that's the only thing that you can do and it's done, right? Or you can just have it as an existing, even after the corporation is gone that sponsored it, it exists as its own entity, pays out, Jared's pension for 25 years or whatever that is, and it goes from there.
Interesting.
Right? So it's not like you're committing to one thing and you can't have options to get out if the situation does change.
Okay. That's good to know, because more often than not in business, things, they just inevitably change, and you can do as much planning as you possibly want, but things will just kind of crop up, and sometimes you do need to pivot a little bit. And I mean, probably a big one would have been some of those COVID years. Maybe you had this set up during those times. Maybe there wasn't that excess cash kind of floating around, or maybe you'd been planning to put this into place, and then maybe it doesn't come to fruition based on the fact that things changed quite a bit.
Yeah, so, revenues or stuff.
Yeah, for sure. Yeah. So yeah, it's good to have that piece in mind too. Similar with some of these permanent life insurance policies, I think a lot of people get hedged in that, it's in there and it's done and I can't touch it and it's just for when I pass. But there are ways to, use that during your lifetime to potentially fund the business in different ways. So having some flexibility is probably a good thing.
Yeah, on our team, we really do focus on not creating planning that's brittle.
Okay.
And having flexibility, right? And simplicity when you can, right?
Nope.
And so you collaborate with the other professionals that the client chooses to have, and you try to decrease how much brittleness there is. Because if there's brittleness, there's a very narrow set of scenarios that work. Right. And you really don't want that happening. Right. So a good example during COVID, say you had an IPP already sponsored and it was already maturing and it was doing well, but something happened to your business.
Yep.
Right. It's creditor proof.
Okay.
Right. So the IPP is protected for you, which is really good. Right. That makes it so that there's a fire break there. You can't, those creditors can't reach through even if they wanted to.
Right. Yeah. In a ongoing world of changes, it's good to have some of that creditor protection. And if you can protect your assets, especially if you've spent a number of years building up some good value in that business and you can move it over to that IPP and protect yourself long term, probably a decent move in most respects to do that. So,
and ultimately the IPP's purpose is to provide cash flow for you to live a lifestyle. Right, to make sure that you're okay, whatever happens to the business, as long as there's enough in the IPP and other assets that you have. Right?
Okay, no, that makes sense. So we've touched on this a bit, but how is that IPP funded? Is there a specific manner in which that gets done? Is that coming from, you touched on maybe the business is putting into that? Does the individual contribute? How does that kind of work?
So it's the corporation.
Okay.
So they're tax deductible payments that go through.
Okay.
And you would know more about that in the tax world for yourself. Okay. Because it is a registered pension plan with CRA, there are certain return metrics that they look at.
Okay.
So as an example, like there's something called a triennial review, which means that they review it every 3 years, right? And if they say, oh, well, the returns have done okay, you can actually top it up. You can put a little bit more in than what they expected before. If you've done really well, they might say, actually, you can't put any more in because of that, right? So there's certain rules around that.
Okay.
But you can be opportunistic if you're with the right wealth team because you can actually set the triennial review at a certain time.
Okay.
Right? So if you have a bit of a market that's weaker for a period of time, you can reset it and push even more money into it and take advantage of that if you want to.
So with it being funded through the corporation, we're talking cheaper after-tax dollars that are going into this.
Yeah, lower tax rate, yeah.
For sure. So that's a good way to build that retirement pension. Some of your other options obviously are just continuing to take the funds out via salary and put them into the RRSPs. Yeah, you've got that deferral there, but again, depending on where things land in retirement versus where you're starting from, does it turn into a permanent tax savings? I guess kind of tough to say. Or you're just taking all that excess cash and putting it into an investment account. Again, can be beneficial, but it might throw you offside on other rules if you're trying to maybe keep that business in a state where you could potentially sell it and claim that capital gains exemption. So I would be of the understanding then, if that IPP was to survive that corporation and is protected from creditors, would that be a separate piece in respect to the corporate assets for determining the breakdown of active assets in that company?
That's a great question. I mean, you're more of an expert in that area than I am, but it is a truly distinct part of it, right? So yeah, it is, you can invest in lots of different securities just like you would in RRSPs.
Okay.
Right. And it's a lot of it is passive income, obviously.
Right.
Right. But there's no rules like active versus passive in corporations like you're alluding to, right?
Right.
Which would be much more difficult, I think, for you to take those strands and separate them.
For sure.
Right.
For sure.
So it keeps it a lot more distinct and cleaner, and the business owner can see these are my funds for longer term lifestyle needs. I'm creating value in this business. Maybe I want to crystallize that at some point, but I'm good with what I have over here too.
Right. So you're essentially creating a separate retirement vehicle for yourself, funded through the business, but kind of wholly owned by you off to the side. So it's protecting you in a lot of different cases, just the general creditor protection. It's probably getting rid of some of that liquid capital that could potentially throw you offside on some of those active business rules, sticking it into a, like you say, a completely different entity, and you're able to then kind of capitalize that upon your retirement down the road. So,
and you can do income splitting, right? Like when you're retired, right? So the spouse or the other beneficiaries can have access to some of those funds, right?
Interesting.
When in reality, maybe it's only one person really working in the corporation or responsible for the corporation.
Right.
Or the corporation's only owned by one person 100%.
Right.
Shares.
Right.
Right. So it is a way to sort of also distribute some of that wealth after it gets turned on, throughout the family.
Perfect. So yeah, that's probably a good point if we're then tapping into maybe some of those TOSI rules. Depending upon your situation, maybe you're retiring before 65. Maybe there's no way to get some funds out to your spouse at that point in time, but maybe you took the steps to talk to Kit when you were in your early 40s. You set this up, you got an IPP there, and you can use that to split some income with the spouse there. And that gives you some added opportunities in that respect. Because I would say, from the most part, anytime you can find some options for splitting income within the family, you're going to be so much further ahead as far as tax goes, for sure. So
yeah, we all know how hard it is nowadays to find those opportunities. So yeah, no, and there is a bit of beneficiaries also. So longer term, second generation, there's options there too, right? That's usually a discussion though that doesn't happen until the people that are the main beneficiaries of the IPP have been drawing it for a while, a period of time.
Okay.
Right? Because then they're more comfortable in their own lifestyle and their situation.
Right.
So that door's open, but it generally doesn't get walked through until a bit later on.
Right, because you would want to establish some of those retirement years to say, okay, here's my nest egg. We've been kind of drawing from it. We're comfortable.
Right.
We can see the underlying growth in the investments that we have within it. And presuming we live to X years, again, always a bit of a guess, but based on that, then we should be able to see some of these funds maybe passing on to the next generation or whatever the case is.
Yep.
Okay.
And I know you mentioned it, but it is tax deferred growth, right?
Right.
Because it's
For
staying there. So if the IPP's alive for 30, 40 years, right? That's a significant amount of time that it's tax deferred growth inside there, just like an RSP, but
Right.
at the small or the medium business, the tax rate, which is a different rate than the personal rate, as you know.
For sure. For sure. So I guess if someone got to that juncture, they'd be funding this via their private corp for however long. They get to the point where that corporation isn't going to continue on. Maybe they were in practicing doctor or something to that effect. And the kids aren't going to continue on in that there's no use for that company. They haven't retained any other assets in there because they've essentially moved everything in this IPP. You can then just close down that corp, and then you've got this IPP onto its own, and then you're not having to pay the accountant and the lawyer to consistently file tax returns for you on an annual basis with that corporation. So
there are still the actuarial annual filings and the triannual stuff that's required, but that creates the optionality and created the IPP in the first place, right? So that's sort of cost of doing it, but that cost is easily taken care of if you can contribute more, right? Because it's significantly more over time, right? So if you took a business owner, there was one scenario that I looked at that, basically over a period of time, the amount of assets were double of what a traditional RSP would have done. right? So that's a significant amount, especially if you have a certain lifestyle needs or you really want to have a lock solid lifestyle program, right? In the back.
Yeah. No, that's interesting. So if I open up this IPP, is there some sort of limitation on the investments that I can put into it, or am I kind of fairly open-ended, similar to maybe a TFSA and RRSP in the type of underlying investments that are in there? Do I have choice over that? Is that something that I kind of work with you and your team to determine? How does that kind of transpire?
So anything that is in a TFSA or an RSP eligible would also be eligible for an IPP.
Okay.
The wealth management team that you're dealing with will have different philosophies around what that looks like. So I can't speak to other setups, but I know what ours are, and they are similar to our non-registered accounts or other corporate accounts.
Okay.
But the key is there's no tax consequences, right? Which is quite helpful in terms of changing portfolio composition over time. There's no tax considerations when you're doing that, which is just beneficial to give us flexibility to manage that over the years, right? Because at the end of the day, we have to take out the income, but we don't have to deal with the capital gains or other challenges that you'd have with another type of account.
Okay. No, that makes sense. And I think that's always important to understand, because I don't know, I think that maybe the general consensus out there that a tax-free savings account is a savings account, but when in fact it can be all sorts of different investment types that you can put into that particular investment vehicle. Similarly speaking with the RSP or the IPP. So maybe when you're getting this set up in your early 40s, I don't know, again, what you guys maybe recommend, and it's probably dependent on everybody's situation, but maybe you're able to take on a bit more risk, I guess, in your younger years. And then as that IPP kind of gets further down the road, maybe you're translating those into slightly risky or less risky assets to ensure you're preserving some of that capital into those retirement years. Is that kind of something people go down the path of doing?
Some people do that. I think really actually a more fundamental question is asking what is risk?
Okay.
Right. And for us and our team, risk really is the possibility of destruction of capital. Right. Not the volatility of day to day. Right.
Yep.
So that's how we see it. The tax-free savings account really should have been named the tax-free investment account.
I would agree.
Because that's the power of that is in compounding over longer periods of time, right? On an after-tax basis, right? So, yeah. But sometimes people are more comfortable with changing the portfolio as we get closer and closer to distribution. We do want to have a certain amount of dollars that are there that do not change based on whatever happens in the marketplace.
Okay.
So Jared's set up for the next 2 or 3 years. You know, he gets the amount that we've agreed on and he can live his life and go on a cruise or whatever. And there's no saying, well, guess what, Jared? No. Craft dinner this year because, you know, the IPP didn't perform for you. That's not, we don't want to have that situation happen.
I would agree, because I mean, when you get to that point in life, you've worked hard and, you know, it's probably going to be a fairly emotional break to move on from that business that you've maybe put 3 decades or so into. So when you're finally able to maybe move on to the next adventure in life, you want to make sure that those hard-earned dollars are going to be there for you. And I would agree with you 100%. You don't want to be in something that is going to put you in the position that negatively impacts your capital. I mean, yeah, the market ebbs and flows, but I think we should all be trying to preserve that capital as best as possible in whatever manner that is. So I would agree with you on that fact.
Well, the first rule of Warren Buffett, right, is don't lose any money.
Right.
The second rule is to remind the first rule. So
makes sense, I guess.
I mean, that's as a goal, you try. That's what you're trying to do, right?
For sure.
Right? That's what real investing is, right? So.
Yeah, because I mean, if you're riding the ebbs and flows, trying to hit it at the right time to get the big booms, I think generally speaking, in me talking with people, you kind of end up doing the opposite. You're buying the highs and then you're selling the lows. And then if you continuously do this, you find yourself with no capital left. And I've seen it negatively impact.
You can learn more about a forecaster from a forecast than about the future.
Fair enough.
Right?
Yep.
So I think we all need to keep that in mind. But in terms of an IPP, it is a great vehicle for certain people to accelerate their savings and accelerate that certainty for them to be good in retirement and their lifestyle and everything else, right? When you're talking about that period of time when maybe you sold the business or you stopped practicing and stuff, it's very emotional. It's a tough period of time, and having the financial piece of your life set up and answered is really powerful.
For sure. Because I think that then gives you the option to maybe jump into another passion that you've maybe had for a good chunk of your life that maybe you just haven't had the time to otherwise get into. Maybe it's volunteering at the local soccer pitch or at your church or whatever the case is. And if you know that financial piece is in place, you could probably step back from that business, put yourself wholeheartedly into the next project, and you don't have to worry about where the dollars are going to come from. And I think that would probably be hugely rewarding for that business owner to be able to take that passion from one place, stick it into the next, and not have to deal with the dollars on the backside.
Yeah, you could get involved in another business, but not have to. Your lifestyle needs would be totally taken care of, right? And then you could do whatever with other assets if you wanted to, right?
Yeah, you just come alongside then maybe just more of an advisory role. Maybe you're helping the kid on his startup project, and you're just there to be there to give some support. And that's awesome. So we touched a little on this as well. So what happens to my IPP in retirement? What are my options? Does it stays as an IPP through my retirement years? Do I have options to do other things with it? How does that kind of play out?
Yeah, we touched on it, but the first option is to keep it as a pension, right? So it operates as a pension for you, subject to CRA rules. So you can take out a certain amount. You can take it to the spouse and the main beneficiary. The second is you can purchase an annuity. Depending on interest rates and stuff like that, may or may not be attractive. You might be comfortable with owning a portfolio and seeing it go up and down, but overall up over a long time and not having to deal with the certainty of an annuity. So that's a different one. And then you can also transfer to registered or LIRA plans, right? And start to work that through. Now, the reason why you might do that is because there's maybe health concerns or something else changes in your life, right? If there's a marital breakdown or different things, right? And sometimes that happens, and so you have to deal with that when it happens. But those are your big options in terms of how it works.
Okay, no, that's fair. So generally speaking, if you get to this point, you're not going to be adversely impacted tax-wise as long as if you're moving it within, I guess, the registered side of things.
Right.
Okay.
Right. And it gives you some flexibility to draw it down maybe quicker if, say, your health is something.
Okay.
Right. So, because there's an unlocking that you can do for LIRAs. There's different ways and strategies to do it, but yes.
Okay. And does the unlocking, does that kind of work in a similar fashion as that LIRA? Is that kind of how it works within that IPP, or you kind of have a bit of a more accelerated option in respect to
no,
that?
well, say you have a LIRA, the unlocking, what it does is, at least in Alberta, under Alberta legislation, you can unlock 50% of the LIRA and put it into an RRSP.
Okay.
Which makes it so that you have no limitations on withdrawals.
Right.
Now, you still have to pay tax on that.
For sure.
But there's no limitations on withdrawals. Whereas in the LIRA, which turns into a LIF, right, you have that maximum. Right. So the government's not letting you withdraw.
For sure.
More.
For sure. Okay.
And that's more of a tax planning thing that you would talk with clients, right? If a situation was when there's a health or other situation that would sort of accelerate that. If everything's fine, keep it in the IPP and
for sure
move on.
For sure. But good to know, health concerns do pop up. You just never know how things are going to pan out. So good to know that you do have some options there. You're not pigeonholed and taking this thing to the grave. There are ways that you can maybe access some of those funds a little bit quicker if needed. Now, again, similarly, if I pass away, I would presume that my IPP that my corporation is funded, that's just going to transfer at cost to my spouse. Is that typically?
Yeah, there's a spousal. Yeah,
spousal rollover.
Yeah, with the beneficiary. Yeah, there's as long as they're both that. And then there's also like the second generation, right, which is a bit more complicated. We can't probably get into it here, but there's other options too. With sort of flowing that money down.
And generally speaking, would you, and I know you've kind of mentioned this before, you would get to a certain point where you've maybe solidified the IPP to a certain extent before you start talking second generation. But would you maybe involve some of that planning if that corporation was intended to maybe keep going? And maybe what I'm kind of getting at is if it was initially set up for the individual listening to this, they are able to get to the point where they can transition that business down to the child.
Right.
Could the child then kind of continue on with that IPP? Does it flow that way?
Yes.
Okay.
But I think in your situation, most likely what would happen is that if the child is paying something for the business to the parents, let's say, then the parents have the IPP separate,
Yeah.
right, and distinct. They're comfortable, they have their own lifestyle and everything else, and then they would get paid over time for the business.
Right.
And then that child could start their own if they're not comfortable, having one with their parents.
Okay.
Right. So because that way it creates an income stream for the exiting partners.
Correct.
And then the existing person buying it doesn't have to pay for their lifestyle
Right.
longer term, right? Which could impact the business, right? If you're taking
100%.
too much leverage from outside, like debt from outside to finance the purchase or other things, right?
So at the end of the day, that IPP is essentially tied to the individual that the corporation sponsored to begin with.
Yeah, the beneficiaries.
Yeah. So whether that business kind of continues onwards or not, that IPP flows with that original owner. New owner could potentially set up his own as he sees fit. But yeah, maybe that then becomes somewhat of a mitigating strategy to kind of move that business on to the kids if you're kind of foreseeing it. And again, you're maybe looking way down the road in a lot of these respects. But a lot of times, if you're transitioning that business, you need that business to keep performing to ensure you can maybe take that vendor take back payments over the course of time.
Sure.
So if you have the foresight to say one or more of my kids could maybe take this on, if I maybe stop taking dividends in my late 30s, switch over to salary, I set up this IPP. When it comes time to sell, maybe you're putting your kid in a little bit better position cash flow wise in order to take this business over because you've got your predetermined retirement nest egg set up already and they can move onwards without maybe having such a burden on their backs to get you cash through retirement.
So absolutely, because the thing is that you basically have way more flexibility when it's like that. Right. And who knows if your kids are going to buy it? Maybe there's a third party that wants to buy it. But either way, then you can be more patient about the pricing or whatever else.
Good point.
Or the terms, because you know that your lifestyle is secure, go forward, and you don't have to maximize a certain thing. Right. So the same thing actually happens, not in the IPP space, but in farm families.
Okay.
The same thing is if you have outside assets outside of the farm, very helpful.
For sure.
Right. Because it gives you flexibility. Right.
And I think we could probably both agree that the flexibility is a huge point because markets change, the economy changes, the tax rules change. So if you can keep yourself as open-ended as possible when you start making these plans, you're just going to be better suited to maybe having to adjust them down the road. And like you said before, keeping things simple, keeping it as broad-based as possible, you're going to be set up for the best possible options down the road.
And the other thing to consider too, like emotionally, right? And mentally, it's a big strain, right?
For sure.
If you're the business owner and you're trying to sell it because you need X amount of dollars to fund your retirement or whatever else, right? So there's that cost to it, that you can't see, but you can definitely feel it, right? When you're that couple that's trying to sell their business that they've been working in for a long time.
For sure. Yeah, and I know personally I have seen situations where it has passed from mom and dad on to the next generation and then it doesn't work out. And, that's going to add a lot to that family dynamic going forward.
Yes.
Because, maybe you're able to collapse it and maybe bring back some of those assets or whatever and liquidate them. But again, like your point earlier, the timing is not what you have selected then. You're just taking whatever you can on whatever it is that you got left just to liquidate and move on from there. So you're not left in a position where you're moving forward in strength. You're just dealing with what you get. So
the business environment changes, right? What could have been a really great business 10 or 20 years ago might not be.
Right.
No,
and that's very true.
So would you rather have the cash, or would you rather, most people realistically,
sure,
they
might
king,
not, right?
They might not want to run a business, right? Maybe. Right. And, you've seen in situations where there's 3 kids and they all get a share of the business. Well, how is that going to work? There's 3 brand new partners that maybe have no interest. 2 of them have no interest in the business.
For sure.
Right. And maybe their relationships are strained as is.
Right.
So do the parents really want that?
Right. So again, the IPP may be your route out of some of these emotionally unpleasant discussions that
it'll give the opportunity for whoever the business owners are to say, listen, we're okay in terms of our situation.
For sure.
And doing whatever we want to do when we don't have the business. Are any of you interested in it?
Right.
Right. And if they canvass them and they say, well, no, well, then they know, okay, we have the green light to just pursue trying to sell the business to a third party, right? Sure. But there's no time restraint on that, right? So like maybe your example had to do with a fire sale. Maybe there was a health issue that happened to a business owner and they go, I can't do this anymore.
Yep.
Right? And then they're forced
to
do something, right? So you never want to be forced to do something and get caught in a corner.
I agree. Yeah, and when we're talking legacy and business transitions, yeah, I would agree the dollars are important, but to me, the most important thing for me is the relationships that underlie that family. Can you get through this period of time and you still come together and sit down for Thanksgiving dinner? If you've got a plan in place that gets you from A to that point, I think you're doing well. Yes, everybody wants to get the maximum amount out of it. Yes, they want to minimize the tax, but at the end of the day, if everything falls apart as far as the relationships that are underlying that family structure, I don't think that was a great plan to begin with. So,
yeah, oftentimes in business transition or farm transition, there's one spouse that really wants family harmony as one of their objectives.
Yep. 100%.
That's exactly what you're saying, right?
Yep.
So yes, the money is, and the assets transfer and all that stuff, it's important, but, there
are probably more important things.
Yeah.
Fair enough. Anything in closing on IPPs that we didn't touch on that you think you want to get out there for the audience?
I just think, just as a summary, IPPs are a tool that not a lot of people know about.
I would agree.
And I think, especially for professionals and for business owners, right now, given everything that's going on in terms of the structure of tax and everything else, and you can speak to that more, but I think it is a really good option to consider if you want to confirm and protect your lifestyle for the future, but also want to be very effective about it going forward. So,
no, I would agree. I had a little bit of knowledge going into this, but this definitely opened my eyes to some things, and I can see where there are some opportunities for certain clients that are in this niche to potentially put this into place, because I think it would be hugely beneficial. And the transition piece, I hadn't really discussed that in any detail with anyone before. So I appreciate going through that. To me, that's definitely a useful piece for a lot of clients. So.
Yeah, don't get stuck in a corner, right? Whatever, if that's an IPP, if that's another thing, right? Just try not to get stuck in a corner, because that'll limit your options either when you're retired or before you want to retire.
For sure. No, that's great. So Kit, I just want to say thanks again for hopping on the podcast with me. If anybody in the audience wants to touch base with you, what is the best way to get a hold of you?
You can go online. I'm a member of the MacDougall Wealth Management Group with National Bank Financial here in Red Deer.
For sure.
Or you can just contact Jared and he can forward my contact information. But
for sure,
we have clients all over Alberta. So geographic location doesn't really matter as much in terms of what we do, but we really pride ourselves on having a relationship with our clients and getting them to where they want to go.
For sure. Excellent. Thank you again, Kit. Really appreciate it. Once again, for the Tax Talk podcast, Jared Pallon here. Thanks again for listening. We will see you on the next episode. Take care.